purpose of this video is to review the two methods for creating the operating section of the cash flow statement, specifically the indirect and direct methods. Recall that the indirect method begins with net income, makes adjustments for non-cash expenses, and then makes adjustments for any changes in the operating assets and liabilities of the company. Note that we're given information related to the operating assets and liabilities of the company in the problem data. Let's start by calculating what the differences are. In accounts receivable, we can see that there was a decrease of $7,000. In inventory, we can see that there was an increase of $5,000. In accounts payable, we can see that there was an increase of $4,500. And finally, in interest payable, we can see that there was a decrease of $800. Now we're ready to start the actual operating section of the cash flow statement. We'll begin by writing down net income as given to us in the problem. Next, we will add back any non-cash expenses as given to us in the problem. Note that we have depreciation and amortization as non-cash expenses. So we're going to add back depreciation of $50,000 and amortization of $20,000. Now we're ready to make adjustments for the changes in the operating assets and liabilities of the company. Since accounts receivable decreased, it means that the company has actually collected additional funds from receivables that were existing in the previous year. So that would increase our cash flow. Inventory has risen, which means that the company has made additional investments in their inventory account, which is a reduction of our cash flow. Accounts payable has risen, which means there are some expenses for which the company has yet to pay. That increases our cash flow. And finally, we have interest payable that has decreased, meaning the company has paid a previous payable. When we sum all of those items, we come down to the total cash provided by operating activities for the company.